For almost 2 decades, since the year 2000, China's power demand increased at a compounded rate of 9.4%. At the same time, the country's GDP compounded at 8.7%. Historically, power demand in China has grown at 1.1 times the GDP. India's power demand has been 0.9 times the real GDP growth. In the last 3 years, though, the multiplier for India averaged at 1.2 times. And there is good reason to believe that India's power multiplier ratio will be a critical indicator of India's economic trajectory in the coming decade. India's electricity consumption per person rose to 1,331 kilowatt hour in fiscal 2023. This was led by increase in manufacturing activity, rising domestic consumption, rural and household electrification, and extended hours of electricity supply. Globally, the electrification of automotive energy has been a key driver of power demand. Further, to reduce the share of fossil fuels and meet the net zero emission status in 2050, electric mobility needs to rise to 30% by 2030. As per Ola Electric, in India, electrification is most evident in the two-wheeler space, which would see EVs account for 50% of the total sales by financial year 2028. But EVs are not the only power guzzlers. Rising per capita income in India is driving higher household ownership of electrical appliances like air conditioners. Then comes manufacturing automation. Factory shop floors in India are undergoing a significant transformation to cope with the requirements of globalization, shorter product life cycles, changes in market and demand, and rapid technology advancements. We are witnessing manufacturing companies transitioning from rugged machinery workshops to flexible and reconfigurable systems. This is to reduce the lead time between different products. The goal is also to connect humans and machines, that is, smart systems, to achieve flawless flexibility and agility at the lowest possible cost. This involves the adoption of both hardware and software technologies, including integration of IoT or Internet of Things and IoT devices, RFID systems, and smart sensors on machinery that allow real-time data collection. In India, the size of the industrial automation industry is estimated to be $2 billion, while its growth rate is approximately 11.6%. Also, the size of the industrial automation segment in India is expected to grow to almost $7 billion by the year 2030. And then there are the data centers. With over 880 million internet users and a thriving technology sector, India's data center capacity has seen massive explosion. It is poised to accelerate further with the rise of AI. Global cloud service providers such as Amazon Web Services, Google Cloud, and Microsoft Azure have established presence in India. The demand for power from data centers has grown at around 5% annually on an average. However, with demand growing exponentially, there could be significant stress on the power grid. Given the strong power demand outlook and the need to transition to green power, the Government of India has outlined an ambitious capacity growth outlook for the power sector. As per the National Electricity Plan released by the CEA in 2023, India's total installed power capacity will rise from 400 gigawatt in 2022 to over 600 gigawatt by financial year 2027. Thermal will account for 39% of this expanded installed capacity, while solar and wind will make up 30 and 12% respectively. Further, by the end of financial year 2032, total installed capacity is projected to rise to 900 gigawatt, with solar and wind together accounting for 53% of total installed capacity, even as thermal's share is expected to fall to 29%. Despite the bullish stance on the outlook for the power sector, there are some critical challenges that could hinder the performance of companies on the stock markets. The first is the delay and high debt in the execution of new capacities. The timely completion of generation and transmission projects is vital for companies to achieve their earnings targets. However, generation and transmission companies may face issues related to land acquisition. Project delays can also be a result of supply chain issues and high debt levels for new power plants. Second is the low profitability in renewable energy projects. In the case of renewable energy projects, the tariff is fixed in advance for the life of the project, generally up to 25 years. Such projects have their own set of challenges such as lower than expected plant load factor or utilization, delays in transmission connectivity, cost overruns, or a quicker than expected decline in efficiency for solar panels and wind turbines. Third is the competitive intensity. Competition has risen in power generation and transmission over the years. Given the strong capex outlook, companies across the sector have strong growth plans. Hence, competition intensity has increased over the years. Similarly, the return on equity in plain vanilla solar or wind projects, which are simpler to execute, is likely to be lower at 12 to 15% versus more complex projects. Finally, there's a distance between the generation and demand centers. As power generation sites are often far from the major demand centers, substantial investments are required in transmission networks to efficiently transport electricity. Moreover, rising costs associated with transporting coal, including the need for new rail infrastructure, further emphasize the importance of cost effective transmission solutions. Grid reliability concerns is also an important factor. Instances of grid failure and tripping necessitate investments in transmission infrastructure to improve resilience and prevent disruptions in power supply. Peak electricity demand in India has grown from 164 gigawatt in fiscal 2018 to 243 gigawatt in fiscal 2024, clocking an average growth rate of 6.8% in the past 6 years. With India being amongst the lowest per capita consumer of electricity, there's a long runway of growth for power producers, transformers, and financiers, as well as exchanges. So, investors need to keep a watch on the old economy power stocks like NTPC for not only their own growth prospects but also the upside from stakes in new age businesses related to power. For the uninitiated, NTPC is India's largest power utility with a total installed capacity of almost 76,475 megawatts, including the JVs. Established 1975, NTPC is steering ahead to be India's largest integrated power company and targets to become a 130 gigawatt firm by 2032. Meanwhile, its subsidiary NTPC Green Energy, which just had an IPO, plans to invest rupees 1 trillion in solar and wind assets by financial year 2027. NTPC Green Energy has an installed capacity of almost 3,200 megawatt. It is aiming to take up the same number to 6,000 megawatt by March 2025 and 19,000 megawatt by March 2027. The company will operate at a level where 90% of the capacity will be solar, which requires an investment of rupees 50 million per megawatt, and the rest will be wind, which requires rupees 80 million per megawatt. Apart from these, there are several power sector stocks that can prove to be long-term wealth creators if bought at the correct valuations. Check out the Equity Master Screener for more on this. Hope you like this video. Thanks for watching.